Welcome back to Finance Kida, your go-to channel for mastering finance concepts and acing interviews. Today we'll explore Ind AS 36, impairment of assets, a fundamental topic for CA aspirants. If you're preparing for interviews or just looking to sharpen your understanding of this standard, you're in the right place. Before we start, check out the description for links to our other videos on accounting standards and finance topics. Don't forget to subscribe, share this video with your peers, and watch it a couple of times to solidify your concepts. First up, let's examine the objective of IND AS 36, impairment of assets. The primary aim of this standard is to ensure that an entity's assets are carried at no more than their recoverable amount. This is crucial for providing a true and fair view of the financial position of the organization. By requiring entities to assess their assets for impairment, Ind AS 36 helps prevent overstatement of asset values, thus enhancing the reliability of financial statements for stakeholders. Next, let's define impairment of assets as per Ind AS 36. Impairment occurs when the carrying amount of an asset exceeds its recoverable amount, which is the higher of its fair value less costs to sell and its value in use. This definition emphasizes the need for regular assessments, ensuring that any loss in value is recognized promptly. Understanding impairment is essential for maintaining accurate financial reporting and safeguarding stakeholder interests. Now let's turn our attention to Ind AS 36, impairment of assets, a crucial standard in financial reporting. The scope of Ind AS 36 encompasses all assets except for those specifically excluded, such as inventories, construction contracts, and deferred tax assets. This means that it applies to tangible and intangible assets, ensuring that entities regularly assess whether their assets are impaired, reflecting a true and fair view of their financial position. Next, let's clarify what a recoverable amount is and how it is determined. The recoverable amount is the higher of an asset's fair value, less costs of disposal, and its value in use. Fair value considers market conditions, while value in use involves estimating future cash flows discounted to their present value. Understanding these concepts is essential for entities to accurately assess asset impairment, safeguarding stakeholders' interests, and promoting transparent financial reporting. Now, let's focus on Ind AS 36, impairment of assets, particularly the differentiation between value in use and fair value, less costs of disposal. Value in use refers to the present value of the future cash flows expected to be derived from an asset, reflecting the asset's utility to the entity. In contrast, fair value less costs of disposal is the amount obtainable from the sale of an asset in an orderly transaction between market participants, minus any costs associated with the disposal. Understanding this distinction is crucial for accurate impairment assessments and financial reporting. Next, let's identify the indications of impairment as per Ind AS 36. External indications include significant declines in market value, adverse changes in the economic environment, or increased market interest rates affecting the asset's value. Internal indications might involve obsolescence, physical damage, or underperformance relative to expectations. Recognizing these indicators promptly is essential for maintaining accurate asset valuations and ensuring compliance with the standard. Now, let's focus on the purpose of conducting an impairment test under Ind AS 36, impairment of assets. The primary aim of an impairment test is to determine whether the carrying amount of an asset exceeds its recoverable amount. This is crucial for ensuring that financial statements reflect the true value of the assets held by an entity. If an asset is deemed impaired, it necessitates a reduction in its carrying value, thereby impacting the income statement and overall financial health of the organization. Next, let's discuss when an entity is required to perform an impairment test. An impairment test is mandated whenever there are indications that an asset may be impaired, such as significant declines in market value or adverse changes in the economic environment. Additionally, annual impairment testing is required for certain assets like goodwill, regardless of any indicators, ensuring that all assets are appropriately valued and that stakeholders receive a transparent view of the entity's financial position. Now, let's dive into the impairment testing process under Ind AS 36, impairment of assets. The impairment testing process involves several critical steps. First, we identify the cash generating units, CGUs, to which the assets belong. This is essential as it allows us to determine the recoverable amount. Next, we assess whether there are any indicators of impairment, which can arise from various factors such as market conditions or changes in technology. If indicators are present, we then calculate the recoverable amount, which is the higher of fair value less costs of disposal and value in use. Finally, if the carrying amount of the asset exceeds its recoverable amount, an impairment loss is recognized, adjusting the asset's value on the balance sheet. Now, how is the carrying amount of an asset determined? The carrying amount is essentially the asset's original cost, less any accumulated depreciation and impairment losses. This value reflects the asset's current worth in the financial statements, ensuring that stakeholders have an accurate representation of the entity's resources. Now, let's explore the concept of a cash-generating unit or CGU and its significance in impairment testing under Ind AS 36. A cash-generating unit is the smallest identifiable group of assets that generates cash inflows independently of other assets or groups of assets. This definition is crucial because impairment testing is performed at the level of the CGU, ensuring that the evaluation of asset value is accurate and reflects the reality of cash flows generated. Understanding the CGU helps entities assess whether the carrying amount of assets exceeds their recoverable amount, thus prompting necessary adjustments. Next, let's discuss how goodwill is allocated to a CGU. Goodwill should be allocated based on the relative fair values of the identifiable assets and liabilities of the CGU at the acquisition date. This allocation is essential as it ensures that goodwill is tested for impairment alongside the CGU, providing a clear picture of the unit's performance and safeguarding against overstatement of asset values. Let's examine what occurs when a cash-generating unit or CGU contains goodwill and the recoverable amount falls below the carrying amount. In such scenarios, we encounter an impairment situation that necessitates an immediate response. The first step is to determine the recoverable amount, which is the higher of the CGU's fair value less costs of disposal and its value in use. If this recoverable amount is indeed lower than the carrying amount, an impairment loss must be recognized. This loss is allocated first to reduce the carrying amount of any allocated goodwill, and then, if necessary, to other assets within the CGU on a pro rata basis. Recognizing this impairment is crucial as it ensures that the financial statements reflect a true and fair view of the entity's assets. This process not only upholds compliance with Ind AS 36 but also enhances the reliability of financial reporting, fostering informed decision-making among stakeholders. Now, let's turn our attention to the measurement of impairment loss under Ind AS 36, impairment of assets. Impairment loss is measured as the amount by which the carrying amount of an asset exceeds its recoverable amount. The recoverable amount is defined as the higher of an asset's fair value, less costs to sell, and its value in use. Understanding this measurement is crucial, as it directly impacts the financial statements and reflects the true economic value of the assets. Next, let's discuss the accounting treatment for impairment loss under Ind AS 36. When an impairment loss is identified, it must be recognized immediately in profit or loss, which can significantly affect the entity's financial performance. Following this recognition, the asset's carrying amount is adjusted, ensuring that it does not exceed its recoverable amount. This treatment not only promotes transparency and accuracy in financial reporting, but also aids stakeholders in making informed decisions based on the entity's financial health. Now, let's explore the concept of impairment loss under Ind AS 36, impairment of assets. An impairment loss can indeed be reversed, but certain conditions must be met for this reversal to occur. Specifically, the reversal is permissible when there has been a change in the estimates used to determine the asset's recoverable amount, and the reversal should not exceed the carrying amount that would have been determined had no impairment loss been recognized. This ensures that the financial statements reflect the most accurate value of the asset in question. However, when it comes to goodwill, the rules differ significantly. Goodwill impairment cannot be reversed under Ind AS 36. This restriction is in place because goodwill represents future economic benefits that are not directly attributable to identifiable assets. Once impaired, the loss is considered permanent, reflecting the inherent uncertainty and subjective nature of goodwill valuation. Understanding these nuances is crucial for accurate financial reporting and compliance with the standard. Now, let's turn our attention to the disclosure requirements under IND AS 36 for impairment testing. Entities must provide comprehensive disclosures to ensure transparency regarding impairment losses. This includes detailing the nature of the asset, the circumstances leading to the impairment, and the amount of the loss recognized. Furthermore, when it comes to cash generating units or CGUs containing goodwill or intangible assets with indefinite useful lives, the disclosures become even more critical. Entities are required to disclose the carrying amount of goodwill allocated to each CGU, along with the assumptions used in determining the recoverable amount. This includes sensitivity analyses that highlight how changes in key assumptions could affect the impairment assessment. By adhering to these disclosure requirements, entities not only comply with the standards, but also provide stakeholders with essential insights into their financial health and the potential risks associated with their assets. This transparency ultimately fosters trust and informed decision making. Now, let's turn our attention to the specific disclosures required for the key assumptions used in determining the recoverable amount under IND AS 36, impairment of assets. Entities must provide comprehensive disclosures regarding the key assumptions that underpin their estimates of recoverable amounts. This includes detailing the discount rates applied, growth rates, and any other factors influencing the cash flow projections. It's crucial to clarify how these assumptions align with the entity's strategic objectives and market conditions. Additionally, companies should disclose the sensitivity of the recoverable amount to changes in these key assumptions. This means outlining how variations in discount rates or growth rates could impact the impairment assessment. Transparency in these disclosures not only enhances the reliability of financial statements, but also provides stakeholders with valuable insights into the risks associated with asset valuations. Understanding these assumptions is essential for informed decision making, ultimately fostering trust and accountability in financial reporting. Let's turn our attention to the accounting for impairment in intangible assets with indefinite useful lives under IND AS 36. Intangible assets like goodwill or certain trademarks are not subject to systematic amortization, making impairment testing crucial. To account for impairment, we must conduct an annual impairment test or more frequently if events or changes in circumstances indicate that the asset may be impaired. This involves comparing the carrying amount of the asset to its recoverable amount, which is the higher of fair value less cost to sell and value in use. Now, what happens when entity changes its business model? When an entity changes its business model, it's crucial to assess the implications on asset impairment under IND AS 36. The first step involves identifying the assets that may be impacted by this shift. This requires a thorough review of the carrying amounts of these assets in relation to their recoverable amounts. Next, one must determine the recoverable amount, which is the higher of fair value less costs of disposal and value in use. If the recoverable amount is less than the carrying amount, an impairment loss must be recognized. Now let's explore the concepts of depreciation and impairment as they relate to IND AS 36, impairment of assets. Depreciation is a systematic allocation of the cost of an asset over its useful life, reflecting wear and tear or obsolescence. In contrast, impairment refers to a permanent reduction in the recoverable amount of an asset, indicating that its carrying amount exceeds the amount that can be recovered through use or sale. Understanding this distinction is crucial for accurate financial reporting as it impacts the financial statements significantly. Next, how does IND AS 36 ensure that assets are not carried at more than their recoverable amount? The standard requires entities to assess assets for impairment whenever there are indicators that an asset may be impaired. If the carrying amount exceeds the recoverable amount, an impairment loss must be recognized, ensuring that financial statements present a true and fair view of the entity's financial position. This proactive approach helps maintain the integrity of financial reporting and supports informed decision making. Now, let's examine how IND AS 36 impacts financial reporting during economic downturns. IND AS 36 mandates that entities assess their assets for impairment whenever there are indicators of potential impairment. In times of economic decline, these indicators become increasingly evident. Market conditions worsen, and the future cash flows associated with assets may significantly diminish. This situation compels a comprehensive evaluation of both tangible and intangible assets to ensure they are not recorded at amounts exceeding their recoverable values. Finally, let's address a critical aspect of IND AS 36 regarding impairment losses. A company may report an impairment loss in one financial year, yet show no significant changes in the subsequent year. The question then arises, can this impairment loss be reversed? The answer is nuanced. According to IND AS 36, an impairment loss can only be reversed if there has been a change in the estimates used to determine the asset's recoverable amount. If the asset's market conditions, operational capacity, or other relevant factors remain unchanged, the impairment loss typically cannot be reversed. This principle underscores the importance of ongoing assessment of asset values, ensuring that financial statements reflect the true economic reality. Ultimately, the integrity of financial reporting relies on adhering to these standards, providing stakeholders with a clear view of the company's financial health and the management of its assets.